Hello traders, welcome to FreeFX. I'm Francesco Sani and today is the 11th of July 2016. This is my 50th video with FreeFX, which is my own free company, and I want to make it a video about my long-term trades which I started last year. So instead of actually going through analysis of current markets, etc., I'm looking at my own trading and trying to provide you with some kind of ideas about this particular strategy. And going forward, what you may learn from this video today is the style of trading called position trading, or long-term trading if you like, which is something very interesting that I started doing in the summer of last year, 2015. So without further ado, here's the disclaimer for FreeFX, and once you've read that, I'll give you 10 seconds. Okay, so moving on to the title of today, which is My Year in the Markets, starting July 2015 and 2016. So let's begin the conversation. First of all, because it's my 50th video, I have tried to sort of find the time to do this, and really at the moment, the best time for me has been today. Strictly speaking, my first position was opened on the 17th of July, as you can see. So that means that, strictly speaking, my video would have actually had to have been done on the 17th of July. Okay, but never mind that. So the important thing is that it's about a year more or less. And I want to start with my my FX book, really, which is the public view of my account. And you can see that the trades I have at the moment are the 7. And I've actually added an 8th just the other day as well. So, but the core positions, if you like, are here, the top 3. And they are EURGBP, so Euro Pound short, Pound Kiwi long, and short FTSE 100 or UK 100. These 3 positions, as you can see, 17th of July last year, and then 24th of August, 26th of August. Then holding these until now, I'm still holding them, and then adding some positions on the 22nd of April, 22nd of May, and then 5th, 6th, and 7th of July. So essentially, from July, August until April, I just had 3 positions. Now, here's the interesting things that I hope to explain today are how do we handle having not just 3 positions, but also going through everything emotionally that is involved, and also managing those 3 positions, and then what happens when we find perhaps that there are changes in what we thought was our strategy, and how to handle that as well. So this video is partly psychological and partly trading sort of technical fundamental video. It's both really. Okay, so let's start with the first position, which, as I said, was a Euro Pound short. Okay, now that was open on 17th of July. So for that, I'm going to go to this, which is a monthly of the Euro Pound. I'm sorry to say that, like many people, I do rely on charts, and some people might be put off by that, but I actually do rely on charts because that's sort of how I started, and I still use charts. So although more and more I'm using fundamentals, but I do use charts to have a view of price, past price, generally, per se, nothing more about that. These lines I put in just to show you sort of price in a visual way. They're not set in stone, and I don't trade off them, so they're just there to kind of encapsulate this movement, which is almost like a wave. And so if you look back to the 17th of July, or we could just go back to, roughly just pull it up a bit, 17th, okay, so we're here, and this is the month of July here, and this is where I entered. And essentially I entered down at the break of 0.70. Okay, so I entered the break of 70, and then the next month it bounced back. Okay, and then it sort of went back down to the same level. So between opening the position on the 17th of July and November 2015, I watched the position going up to 0.75, so 500 pips against me. Okay. What was happening at the time was that I was feeding off information that the euro was still a negative-looking currency in the long term. The ECB in December was to introduce further stimulus, okay, but then we know what happened in December. So here was 500 pips in the negative. Then in November, price came back all the way to pretty much my opening price, almost on the dot. And then in December, the ECB introduced further measures, so expanded QE and other measures, and yet the markets completely bypassed that and actually pulled up the euro across the spectrum, including euro pound. And so it went back up and it re-entered the lower part of the channel. Okay, so at this point I was back about 500 or just less pips in drawdown in the negative. So I waited, and the new year started, and I thought, okay, maybe the markets will digest the ECB's decision. But this didn't happen. So what did I do? I stayed put. At this point, I was getting a positive swap. As you can see, I'm 3.55 positive swap. Okay, so I'm sort of earning interest from that. I'm currently 1,559 pips down. Okay, and so the situation is that, as you can see, from December to now, this currency pair has been rallying hard back into the channel all the way up to the higher end of the channel, and it has broken through. Depending how you draw your lines, but if you're honest about it, if you join these highs, it's broken it. There's no doubt about it. So there's not much that I can say to minimize the outlook for this pair. Technically, it's broken through this channel. Clearly, one candle, that's June, closed just below it, and July just opened above it. It didn't even bother to return. There's no wick here or anything, just straight up and off it went. So we haven't made much progress, but psychologically I'm obviously running short of answers because there isn't technically anything here. Okay, the only thing that you could say is that channels are running also in horizontal lines, because on top of the channel you have this, which is okay, and then you also have this. So the intersection between the swings to the top of the channel and the actual lines, if you continue that horizontally, okay, we have just above 0.9075, and below that we have this 0.8750 something. So currently we're at 0.8540. So this would be our first true resistance. Okay, so if we disregarded the channel and went by this level here, which sort of stands before the channel top here as well, that would be our next level. So if this came back from here back into the channel, I'd be happy. Now, one thing to bear in mind is that channels like Bollinger Bands are flexible. So if you measured from the channel bottom here to the bottom, that's about 350 pips. So from this channel top to here, that's about 430 pips. So there's a degree of flexibility. You can go and break through a channel and then re-enter its path, and again to the upside that could also be the case. So I don't necessarily say that this is the end of my short. One thing I'd say is that having been now over 1,500 pips drawdown, my targets necessarily have changed. So I entered just under 0.70. So if I wanted 1,500 pips to the other side, okay, that's obviously going to be 0.55. Okay, But realistically, if I use sort of the sort of time span between these lows and maybe a breakthrough, the next low will probably come, in 2017 sometime, and so and the target for me would be 0.60. I tend to go in these big moves by 1,000 pips, generally 1,000 pip implements. So increments, sorry. So from one point to the next point, 0.70, 0.60, and so on. But at 0.60, the risk-reward ratio obviously would be negative, because minus 1,500 plus 1,000. So you'd be less than 1-to-1 risk ratio. But there'll be the positive swap. So obviously you'd have to look at evaluate the holding time versus the returns, and other things as well. So I'm in a waiting game with this. It's a slow-moving pair, and the declines seem to, unusually, because the declines tend to be faster generally, but here the declines tend to be slower than the upticks. So if you measure this from here to here, that's 11 periods, so 11 months. From here to here, that's 23 months. From then the last swing high, 7 months. Okay, so so if you imagine this bounced here next month, I measured 23 months, you'd be roughly, okay, so you're looking at June of 2018, just to get back to the channel bottom. But channels and rules are made to be broken, so I just have to wait and see. So this trade is not a successful trade from the point of view that I gave this about, with like all the other trades that I started in the summer of 2015, I gave it 6 to 12 months. So the reason for that was not based on these periods on this chart. It was based on the fact that I'd decided to start a new trading regime, and I'll go to the next trade for that. So this is the pound Kiwi. So I'll just open the chart for that, and you'll see on this that I had quite. I put some notes here. I had quite a lot of. Just open that a little bit more. Okay. Okay, so I had quite a lot of positive trades in 2015, and that meant that I was getting really. I was quite happy with the way things were going. Just gonna stretch out a little bit, so make it a little bit less inclusive. Okay, so you can see from here that okay. You can see that I made quite a lot of short-term trades from about, there we go, that was the beginning of June, and went up with lots of small buy orders, all about 1K. And so my equity curve was starting to pick up quite well. And if you look at the, yes, sort of May-June period, so all these trades were adding up small increments in my account and helping equity as well as balance. So I was rebuilding this account, which I literally hacked to death in the intervening period of mid 2014 down here to end of 2014. So quite a tragic end to what was a good pickup back here in up to September 2014. Up more than 50% and then down, okay, quite a bit. So essentially this run, okay, ended up in the summer of last year with me deciding that it was getting too intense and I really wanted to have some time to myself and not spend every single free moment of the day attached to the screen. And although ironically I actually went self-employed in the summer of last year, so it would have been probably something to look forward to, spend more time trading, day trading, but I actually decided that no, long term is what was interesting for me. I wanted to research fundamentals. I wanted to basically I wanted to get have the freedom to research things, enter trades with a long-term perspective. So I decided that I should give myself a year to evaluate this trading style and see how it would cope as well. And so I did. So for this particular trade, the pound Kiwi that I started in the summer of last year. So as I said, I entered that trade on the 24th of August. If you remember, that was a Monday, and it was the day that the Chinese market crash occurred, and that had huge repercussions in well, Western currencies as well. So the Kiwi took a massive hit, and the pound Kiwi rallied up. And I was watching a short-term trade that I entered that day. So that day I had a trade on, and it went up to over 1,100 pips. And I remember this to the day I died because I was away from here. I was in another city, and I had a laptop open, and I was checking into my web-based account, and I saw the price, and I nearly choked on my lunch. I couldn't believe it. Okay, so I had no idea what was going on. So I quickly closed the trade before things reversed. I managed to close it for 500 and something pips. It was a very good trade. So I was happy with that. But then I started thinking, I looked up the news, what was happening, and I realized it was a Chinese market crash. I looked at the long-term potential for this particular currency pair, and then I realized that there was a inverse head and shoulders pattern, and this is where we are. Okay, so this is the inverse head and shoulders, and that's the shoulder, left shoulder, the head lower, which is down to about 0. Where are we? I'll put it on this side. Okay, so the head is down here to about 1.75, and then the so we're at this point that I entered, thinking that this will continue up to mirror this side and back to about 3.0. So I entered the trade thinking that this would be the point of this pattern, which would reverse this long-term downtrend back up. You can see in light blue, this is the pound US dollar. Okay, and at this point they started reversing. And sorry, completely wrong information there. It's the Kiwi US dollar. The Kiwi US dollar started picking up, and it has been doing so ever since. Okay, so unfortunately for me, it's not quite stemmed this rise, and we got to these levels of 2010. So the Kiwi US dollar is at these sort of critical levels, which would be 0.73. Yeah, we're just about there, pretty much. So it seems to be that there's a lot of buying in a Kiwi, and it has been, in spite of the RBNZ, the Reserve Bank of New Zealand, cutting rates and possibly wanted to cut more rates, but that's sort of for debate at the moment or not. And there's been a lot of slowdown in the dairy industry. And just the other day, yesterday, I was speaking to somebody who actually is from New Zealand and works for one of the biggest banks over there, and they have confirmed that the dairy industry has suffered a massive slowdown, and that there is a massive bubble in the housing market in Auckland. So all these things that we hear about, I actually had this incredible conversation because it confirmed all the things from somebody who works in finance. I wasn't expecting that conversation. It was a complete random encounter. So I was amazed to have this conversation and have all my long-term projections confirmed. And obviously we're at a historical situation because the RBNZ has not had rates this low. So what will happen next is that either they keep cutting rates or they don't cut rates, and the Kiwi dollar continues to rise. The interesting thing here is that the correlation is always inverse between the pound and the Kiwi dollar. So when the Kiwi dollar falls, the pound Kiwi rises. Okay. But at the moment, really, the influence has been more from the pound side. Okay, because the pound has had a tremendous influence. This rise in the Kiwi is not great by any account. So if you have a look at the price, okay, we've gone from 0.6375 to 0.7240. Okay, so it's about 900. Yeah, 900 pips. If you look at the pound Kiwi, it's fallen by much more than that. We got from 2.44 pretty much, and now we're at 1.78. You do the sums. It's massive. Yeah, it's just absolutely incredible. You can just measure it with a ruler if you want, but it's roughly 6,600 pips, 6,500, something like that. So there's a disproportion between the Kiwi rising by 900 pips and the pound Kiwi falling in the same period by over 6,500 pips. There's a massive disproportion. So this move is not fueled alone by the Kiwi's rise. What does that leave me then? So I've been holding from this top. Essentially, this is a top rather than the middle of a wider move. And so I've been holding this losing trade for all this time. So you might be saying to me, well, what is the point of that? And in fact, I should move that lower to 1.75. Okay, make that 1.75. So so we come down to basically we're down to what was the inverse head that I thought would be the point of rallying back to 3.0. So we have a situation now where we're at the bottom potentially, and if we were at the bottom, we had to see what happens next. When we rose from the bottom here, there was a huge period of consolidation here before this rally, and this period went from 23 months, so nearly 2 years. So now we're in a situation where if history did repeat itself, I could be not just a year into this trade, potentially another 2 years before seeing this rise up to 3.0. Okay. There's also negative swap to think about, which is obviously where I'm at, and the negative swap here is just trying to find it. Okay, so the negative swap on this trade is there. Minus £28, okay, and the net profit is 0.393. Okay, so it's quite a big, hefty fine, if you like, on top of the negative pips. Negative pips 6549.90. That's today's update. So it's a massively losing trade. The lot is small. It's a micro, 0.01, so £1,000. Which is how I'm comfortable holding this. Okay, but of course it's a very long trade, so I have no power over making this a quicker sort of scenario where I can just say, okay, let's just do this and that within 3 days, 3 months. If it hasn't worked in a year, there's one or two scenarios. Either my target is a much more long-term target, so I have to sit with this for another year at least, or it could be that in 6 months' time we have another massive rally. Just to give you a sense of why I'm thinking that this is still a good trade, between May 2015 and August. Okay, so basically 4 months we had this rise from down here to up here. That's nearly 5,000 pips, more or less. Okay. So in 3 months' time, it could be that we went from currently 1.78 something. So we could go to 2.38, which is up here. Okay, that's about 5,000 pips. 5,000 pips, 2.38. Okay, I would still be a little bit short by 600 pips, which is not bad really. And then at that point, I could start really thinking that this trade was back on. Okay, actually even before that, to be honest, if we went past 2.25, that'd be a really good point. And so this is really complex. There are lots of things in this, not to mention the fact that the pound is in dire straits because of the UK referendum on Europe, and the fact that the Tory party is just elected now, today, Monday the 11th of July, the new Tory leader and Prime Minister to be Theresa May. So David Cameron's gone, and the UKIP opposition party, UK Independence Party's leader, has gone. And so we have all these upsets to the system. The Bank of England says they might introduce further QE, further easing, so putting more money into the system essentially this summer. They haven't mentioned negative rates, but certainly the 0.50 looks a little bit shaky at the moment certainly in terms of hikes. So the rate hike idea that we had back in 2013 is gone, and certainly it's gone from the point of view of the pound being priced down. So I don't really know about what happens to the pound next, and that has a huge influence at this point. Okay, unless we have a massive downgrading of the Kiwi, which doesn't seem to be likely at the moment, or there isn't enough momentum to go past this price level here, then we are really just struggling to see how long this turnaround will take. Okay, so this is a problematic trade from a fundamental point of view, because it's very negative the pound and positive the Kiwi. Although I have my doubts about the Kiwi positivity, except from a yield point of view, because the Kiwi is at 2.25 for the interest rate of the Kiwi dollar, and the pound is at 0.50. So that is a fact. But going forward, the pound is not necessarily going negative. It might just stay the same for the interest rate of the Bank of England. And the Kiwi is the one that has a premium from which it could actually scale down. So the Kiwi has a lot of selling that it can do. If you look at the Kiwi dollar, we're here, and the lowest level was down here at 0.50. Okay, so we actually have a long way to sell. The pound hasn't got much of a sort of selling point, because we are where we are. We come down as far as you can go, really. So don't really know what we can do in terms of selling, or how much how much profit there is to be made from selling the pound. So I'm acting on the belief that although we've sort of gone further down this level, which was the 1.40, which had held for a long time, even during the great financial crisis tumble in 2008, 2009, this level held, just like back here in early 2002. And so we broke through that, but it seems that we've stopped around this level here, 1.30. We sort of dipped below it, but we're just sort of retreating above it. So we're 1,000 pips from the 1.40, which in the greater scheme of things is not a huge distance, believe it or not. When you think how far we can come back up to the top of this range, this was during the rate hike speculation when Mark Carney came to office in the summer of 2013, and the pound rallied from 1.50 to 1.72. Okay, that's 2,200 points in the space of less than a year, pretty much, or just actually a year, and then coming back down when that rate speculation fell apart. Okay, the coming down was more brutal than the going up, but still. So if we went up to 2,200 points, we'd be at 1.52, okay, which would be a very acceptable level, and we'd be back then in the range between 1.50 and 1.70. This would give the pound Kiwi a tremendous boost and would also hit the euro pound hard. Okay, so we have more potential for the pound going up at this point, and we have more potential for the Kiwi US dollar to come down. Definitely, by any stretch of the imagination, the Kiwi has more premium to the downside if it were to reverse. Of course, now the question is, will it reverse? Because one of the technical aspects of this is that, of course, we have a long-term trend which looks like this. Okay, so if we made this a trend line starting in 2001, and 2008 here will give you a 7-year cycle, and then 2015 here. Perfect. 7-year cycles are the thing that I've been looking at ever since 2015. In fact, when I entered those trades, before that, the year before, I was already looking at 2015 as the target for a 7-year cycle end. So that's why I went short the FTSE 100, which I'll show you in a minute. Certainly I wasn't looking at this in this particular way. The Kiwi US dollar, I was looking at it more from the point of view that this downtrend would continue down. I wasn't expecting this to reverse. At this point, there was no confirmation of this as a trend because we hadn't come to this point. And yes, you could project, but actually, if you projected from here to here, then that would come to here. So you'd had to come down to 0.57 more or less. Okay, so we're still about 600 points from that. So I wasn't really considering this reversing. But if you tilted it this way, okay, and so this is a temporary breakthrough, but a very sort of elastic breakthrough, not really just a definite breakthrough, then that's where we are. Kind of bounced off this. So this will be possibly going up all the way to one of these levels. The next level will be 0.75. But at 75 again, we've got a lot of potential historic orders waiting because it's a good point. It's a good point to sell, and there's a lot of downward potential. So there's a risk to holding this higher, obviously, although the returns are good because of the high interest rate. So the one thing that I've been looking at a lot has been the global day trade index, and this really gives me a perspective on the Kiwi dollar's potential, because there are two things going on. This is where it gets a little bit complicated, and this is why I still believe that eventually the attractiveness of the Kiwi dollar is going to wane. We have the US rate hike situation, which is still ongoing. Now there is a presidential election, and November is coming close, so they're unlikely to maybe raise rates coming up to the election. But the fact is that markets are forward-looking, and the Kiwi US dollar is not likely to raise rates. It's likely to use tools to slow down the housing bubble, because if they cut the interest rate, obviously that will encourage cheap lending, but they're also using a loan-to-value ratio, and that basically is meant to stop people borrowing money, to kind of slow down the housing bubble. The other thing is the actual dairy market. Because of the oversupply in dairy products worldwide, there is a problem with the price, and this is really what I follow. Every 2 weeks in Auckland there's a dairy auction, and this kind of gives you a sense of where we are. Now if you look at the past few months, it's been pretty difficult. As you can see, from January 2016, that's what we are. And if you wanted a sort of a greater range, then I could tell you that last year it was also particularly bad. And this year, sort of, we started with 1, 2, 3 negative auctions, one slightly positive one, another negative one, 2 positive ones, another negative one, 2 positive ones, and one was flat, a 0, and the last one on the 5th of July it was minus 0.4. So basically 1, 2, 3, 4, 5, 6 negative ones, 1 flat ones, and 5 positive ones. So on balance it's kind of okay. But if you look at this negative one was 0 or minus 7.4, it sort of trumps all the positives that we've seen, and it hasn't really recovered yet. So now you have to pay for seeing the historical data, but certainly last year there were a lot of negative outcomes for these global day trade auctions. So it has been a bad, and these do have an influence, because when a bad dairy auction comes along, this was the 5th of July. So if we went back to the charts, and you'll see that one. Let's put it on a daily, and you'll see quite clearly that 5th of July was there. 5th of July was there. So if you look at the 5th of July, it was okay. Let's see if we can see the candle value without the okay. So let's just go for that. Okay, so we had a high at 0.7234, the low 0.7139. Okay, so about 100 pips, which, you know, considering that the ATR at this point was, well, let's see, I'll indicate. Okay, so yeah, so it's not a particularly big shift, but it's still a negative day nonetheless. Okay, so let's go back to where we're at. So these two trades are the first two that I took, and then there's another trade as well, which, as I said, it's an equities trade. Now, why equities? I'm sort of dealing with currencies here, so you might wonder why would I want to dabble with an index? And the returns may be quite slim. As you can see, for going short, I'm paying a dear price, minus £20 for holding it from August of last year. 26th of August I entered. Now the 24th was the Monday, sort of Black Monday. The 26th was Wednesday. And I was watching the FTSE 100 as well, getting pummeled, and I had my eyes on it for a while. So I really wanted to get in while the going was good, and so I did. So let's find the FTSE 100, which, as far as I remember, is here. And maybe I have to create a chart for that. Okay, so excuse me a second. Okay. So the FTSE 100 essentially is in this situation. That if we look at the monthly, we are in a cycle, okay, and as you can see quite clearly, this is the cycle. There's not really a lot to say that the eye can't see. So the 7-year cycle runs 2000, 2001, 2007, 2008, 2014, 2015. Okay, so already in 2015, sorry, in 2014, we were basically in this high area, which then provided the supply. Okay, so then there's a sell, and there are people to buy from. Okay, so this is quite a regular sort of pattern. But then if you look at how long it took from here to here, okay, about 53, 55 months, okay. So give or take, that's about 3 years, okay. And then if you go from here, roughly, to here, that's sort of the first highs here. That's about 50 odd. So it's about the same. But then if you measure how long we've been up at the top, that's about 18 months. That's about maybe 12 months, about a year. This is about 40, 30, 32 months. It's a much longer period. So I entered after watching this chop, and when the crash came, I was actually finally thinking that the spark had come to get this moving. So August 2015, you see that we dropped from 6.70 pretty much down to 5.7 something. So it was 1,000 pips on the month, but a lot of that was on the day. If you look at the daily chart, go back to go back to July. And August, there we go. The 24th of August was here, so you can see that we fell from 6.130 roughly to 5.770. Okay, so that's a fair drop, and then as you can see that we sort of recovered subsequently. So I entered, just to make it really relevant to my video here. So I entered here okay, at 5.990, so just below the 6,000 mark, which is a kind of significant level. I entered at 5.990, just under the 6,000 mark. And then I held, and we're coming to the 22nd of, okay, so by the beginning of October, price had gone back down to 5.920 something, and it started rallying again. So by this time, 29th of October, it was still up here at 6.452. So I was about 500 pips in the red at this point. And then it went back down. It was coming back to break even by middle of November. By the beginning of December, it was back up 500 pips more or less overdrawn. And then it was back into the money. And at this point, I was about 200 pips and more in the money. Then it was again, and then you start seeing this pattern on the daily chart when you think, okay, this is making lower lows and lower highs. Okay, and so is this going to go lower? And it did temporarily. So the best price at this point for me was the 20th of January here, where it was down to 5.5 something. So I was about 400 pips in the money. And then back here at the beginning of February, it was down to 5.561. So I was very happy here. Now, because it'd been 500 pips overdrawn, I wanted to be at least 500 pips in the money to make it a 1-to-1 risk-reward ratio. So it was coming to about the right point. Had I actually closed my position here, I would have been very happy, because look what happens next. It rallied back up and then back up nearly to where it was. And then we had a big drop and back in the money here around the time of Brexit, when we started talking about possibly the Leave campaign, the Leave side winning, and then it rallied back up. And by the 24th, when the result was announced, there was a big drop, and I would have been in the money by a little bit, yeah, nearly 300 pips. Had it actually stayed there and continued, I would have been happy, but it withdrew all the way up, and then it has subsequently rallied so hard, we've gone back up above 6,500. So my target was about 500 pips and maybe double that, have a 2-to-1 reward risk. So double the reward to the risk. And that would have been basically down to, and it still is my target, is 5,000. Okay. So now that target is increased, obviously, even as a 1-to-1, because we're beyond the 500 pips. We're sort of 650 pips. So I'd have to get at least 5,350 more or less. If you put it on a weekly chart, you'll see that 5,500, or rather 5,000 even, is down here. Okay, so there's a definite range between 5,000. You see a lot of chop here and long wicks on a weekly chart, going back to 2010 and 2011. So 2 years around that price, and here as well is kind of leaning on that price. And then the 6,000 range, there was a lot of resistance here, 2011 as well. So this is a range that we've come out of, and we've resisted coming back below 6,000, and we come back here after that August of last year, but it's rallied back up. Now, there are all sorts of ways to draw lines. Here you can say this is a channel, we're at the top of that, we're going to come down again to 5,500 and below. I don't know. Nobody knows. So I'm holding short because I believe that this fundamentally is a short opportunity. So the timing is a tricky thing to do when you're picking a top after such a long climb. But it is a 7-year cycle, and we've delayed it, but it's inevitable. Let's look at the price where we are. Now, interestingly, if you look at the S&P 500, the other big index, the American one, you'll see that there's a divergence here in behavior. So you have to be careful with picking tops and bottoms when it comes to big cycles, because the S&P 500 has a similar cycle structure. As you can see, the climb back here, 2000, 2001, down, another cycle, again, top at the same price, FTSE 100, top at the same price, more or less. And then they had a divergence, because where the FTSE 100 came back more or less to the same price, the S&P 500 went above its previous high, its previous cycle top, if you like, and went double that. So it's basically doubled length of its next leg up. And the S&P 500 as well is in a cycle, and I have also shorted the S&P 500. So if you go back to my FX book, you can see on the 22nd of April, I started seeing signs that the S&P 500 was going to be next, and I really wanted to capitalize on that. So I went short. And this position has been good. I've recently had 900 points, over 900 points in the money with this position. But my target is around 18,500 or 1,850 if you take off one digit. And so from about 2,100, we are at the moment, I went short a little bit below that. But yeah, I believe that that's a target. So I won't settle for 900 points because I want much more. Okay, so I think this is going to go far. If it goes beyond the 1850, it's going to go far. So my incentive here is certainly not the swap. As you can see, the negative one is minus £7.53, holding it from April. Okay, so that's 3 months more or less. So it's expensive, but I think this has great potential again. So the FTSE 100, S&P 500 are my equities long term. I think an equities crash carries a lot of momentum with it, almost like a currency in a less maybe volatile way, sort of flash in the pan. It's much more sustained when it is going to be carried through with some conviction. So it's going to go far. And it may do so quite quickly, which is why I'm in the trade, because I don't want to miss it. So if I am in the drawdown here with the S&P 500 by 450 points, okay, it's because my target is going to be much bigger than that. Thousands of pips, yeah, definitely. So that's not really a concern for me. Then you might say, okay, so psychologically at this point, I had 4 trades on, and all of them negative. Building up negative at this point, we're coming into a year, and I'm still negative, except the S&P 500, like I said, after the UK referendum on Europe last month, it started falling hard. And at that point, I was quite happy with its progress. And you can see if I put it on a daily chart, that it was doing quite well, in fact. So looking at the S&P 500, 24th of June, it came from 2,120 and it came down to 1,995. So if you measure that, that's a fair drop. Okay, it's yeah, 640 pips more or less. Now it's basically recovered. It's recovered all of that. There's no doubt about it. So I don't really have much of a hope that it's going to be an easy journey, because it has to be convinced to come down again. So there must be an event or something of a major significance. But still, that's where I'm at. So that's where we are. The UK 100, the FTSE 100, and the S&P have both rallied back up, as have other asset classes, but we won't go into that. So at this point, I thought, okay, there are other things going on in the market, and I basically at this point I capitalized my account, because my broker FXCM had basically decided that it should write to all its clients and say that the margin requirements would be some of them would be triple the normal amount, so the maintenance margin would be much higher to buffer any effects of the UK EU referendum results and volatile ensuing in the market. So they were honest about it, and I did the right thing. I didn't close trades. I kept these trades open, but I capitalized my account. So if you look at my account here in terms of the balance, you can see it's gone up quite a bit. I was actually putting money around the end of last year. I started deciding that I should really give myself a sort of bonus, because I'd done well in 2015, and although I was holding these long-term trades, I didn't know how well or not well they perform. I thought I should give myself a bonus for this performance here of rescuing my account from destruction and trading sensibly all this way. So basically I gave myself a bonus, and then I sort of wanted to keep putting a bit of money into my account, so just £50 at a time. And then it came to here, June, and I sort of stopped. And then the UK referendum was coming up, so I decided that the margin requirements would go up. There'd be a lot of volatility, so I should fund my account considerably. So I have. So I'm basically back up. In fact, I'm above the levels that I actually gained by trading back here in 2014. So in terms of balance, I'm okay. It's the highest I've had in one account at any one point. But as you can see, the equity is sort of gone up, but that's been pulled up by the balance going up, and then it's gone down ferociously to here. So in terms of the equity, it's not looking particularly good. I am quite significantly in drawdown. As you can see from about a year ago, I've been pretty much constantly at about 70% drawdown, which is quite a lot. You know, a lot of people wouldn't dream of going beyond 30%, and that'd be a lot. So I'm sort of yeah, I'm leading a risky life with this trading style. But the point is that I'm looking at it as a long-term investment. So I'm looking beyond this. If it's possible to explain this in about 100 different ways, it comes down to the same thing. I'm looking beyond that. I'm looking beyond the drawdown. I'm looking beyond negative swap and the frustrations of holding negative trades for a long time. When you look at your account, your trading account every day, as I do, in fact several times a day, it does become very difficult when you see your account in the red by a lot every single day. Two things happen to your trading confidence. One, you start sort of withdrawing from sometimes you start withdrawing from social media because you feel that you don't have anything to contribute. We're just sitting on a trade for such a long time. Most people talk about day trading and talk about the successes and failures and the emotions going on through that. And the other thing is that you start, you get really bored. So it's quite possible that you start wanting to do other things. So what I've done recently is I joined some trading contests because when you have such a long wait for the outcome eventually of your trades, it's quite difficult to know whether you still have an idea of how to day trade. So my idea is that the long-term trading is a new thing. So I have to really put time into it, but at the same time, I haven't sort of given up on the idea of doing shorter-term trades. But because of my account limitations and the investment I've put into long-term management of trades, I can't physically, or even I can't handle any more trades if I wanted to. So I went to do some trading contests, and I'm still doing them. They are a little bit crazy because they give you crazy leverage, and there's a lot of competition for the prizes, so you have to actually step up. So they encourage you to trade bigger, but you can still use risk management and sort of close your losing trades, which I'm doing. But certainly it's difficult to switch off the long-term mentality that we come into. So the second aspect of that is that you get completely stuck in this mentality of holding trades for a long time, and you, in a good way, because you detach yourself emotionally, but in a bad way, you're unable to close losing trades because you think in terms of themes. So my two themes are the equities are overpriced, and no matter what the companies and their profits, no matter what the data for the companies are, the equities as indexes are providing low returns, and therefore at the first sign of a major risk scenario where those profits are going to be in serious danger, people will come out, and when big money will be pulled out of those positions, there'll be a drop that will be very significant. So I'm basically holding on for that event, which will be when it will be. I'm not sure when. So to be in that position means that I won't be cut out of the trade because it'll be too late. I'll be in the trade, and once the drop starts, it won't just be a flash in the pan. The real deleveraging of something like the S&P 500 would be sustained over, I don't know, maybe more than a month, over several weeks. It will give me time to reassess my actual trading targets and decide whether to continue to hold, put a trailing stop at distance, put a break-even stop or a fixed stop, at 2,000 pips in the money. Or just close that trade and maybe re-enter with a shorter-term trade to top it up. So there are different scenarios there for the exit, which are very important. Don't get me wrong, but I'm still waiting. Like the pound Kiwi long here, that trade during that day was insane. But I was already in that trade, so I didn't close it at 1,100 pips because it took me a couple of seconds to realize what was happening. I managed to close it for more than 500 pips. So that was that trade that I took before coming into this long-term trade was an exceedingly good trade. But because I was already in it, because I would have missed it otherwise. So I must say at this point that I trade entirely manually, which is actually a reason why I went into long-term trading, is because I don't use signals and I don't use alerts and I don't use automated trading or expert advisors or any sort of mechanical strategies. I just trade manually by themes. So my theme is, as I said, the deleveraging of overpriced assets and long-term potential of currencies. So the pound has more long-term potential for me, in my view, and the Kiwi has high yield potential at the moment, but it's risky because it's more of a risk currency. So for the long term, that's my projection. So I'm trying to think like an investor rather than a forex trader. And the reason why I'm doing these trading contests is because I want to see how I can trade within a theme, but short-term day trading. And also because, as I said, you detach yourself emotionally, which is a good thing because when you go back to trading day trades in a contest, for example, you can cut trades, no problem. But at the same time, it's quite difficult to do because when you detach yourself emotionally and you see your account in a drawdown over a long period of time, like this, it then becomes you just sit through drawdowns for months and you couldn't care less. You sleep, fine, no problem. You manage your risk, you enter other trades maybe or fund your account further. And that's basically managing the trades. But you're not closing trades, you're not making a final decision. It's a managed position over a long period of time. So any changes will happen very slowly. And that means that you are essentially not trading. You're just managing, you're not trading. So your entire mentality of what it is to be trading changes. And with it changes your attitude and how you get frustrated at things over long periods of time. And you do reach peaks where you are exhausted watching trades develop so slowly. So yeah, basically that's how it becomes a completely different ballgame. So that's really where I'm at, and those are the sort of the core trades. And then I added, as I said, the S&P 500 trade more recently, and then in May I started going short on the Kiwi Japanese yen. So the Kiwi yen is here. This is the monthly chart. So I went short. I'm currently actually positive in this trade, and I've been positive by a fair bit on this trade, about 300 points recently. So it's actually a trade that's doing particularly well. But we now come down to the 70 level, and it's sort of bounced back, and it's sort of struggling to make progress. As you can see, there's a long pattern here, which you know, if you put in a sort of projection, I've actually written an article back in a couple of years ago, probably longer, on dailyfx.com. It was a sort of guest editor, guest contributor initiative, and I actually managed to get myself published there. But the article basically covered this long-term line, and at the time we were back in here, and it was sort of the question was whether we continue higher. It broke through that sort of projected line. It was like an axis running between this bottom and this top and crossing this middle point. This point in 70, as you can see, is like a half point between here and here. It's like a 0.5, 0.50 Fibonacci retracement. So come back to this middle point. So it's like an S shape or a sort of a sine wave. Okay, back to the top, to the bottom, to the top, and back to the middle. So we kind of reversion to mean. And we're back to the middle. So before the last time we actually broke through, there was one point where we bounced back up, okay, then we broke through, then resistance, then back up through it. Now at this point here it came back down. Here it sort of did, but not quite, so we stopped before that and it bounced back up. So we had the bounce, the sort of double bounce back up, and at this point it looks like we're poised to break back below 0.70. So based on those things and on the fact that I still believe that the Kiwi is actually going to lose value, either by bank intervention because they still think it's too high for their exports, or by other factors like risk off, China, which is a major exporting partner for New Zealand. By a number of factors, the dairy situation, etc., I think this will continue down. And also there's the fact that the yen pairs are under threat as a sort of risk set. And I think that's because the Japanese index has been taking a hit. And here's the Japanese. You can see the correlation between a yen pair like the Kiwi yen and the Japanese Nikkei 225 index. Again, another index like the S&P 500 and the FTSE 100, which is overvalued or overbought and is sort of due for a correction. It has started in July, August 2015, again, when it was the Chinese market crash, when I went short on those pairs or long those pairs. So it's come down significantly from above 100, 102 to below 85. And if this continued, then certainly the yen pairs will also continue, no problem. So this again is a long-term trade. It's not doing me any favors. There's a negative swap. As you can see, I've only held it short from the 22nd of May. I've really got minus £3 negative swap. So again, it's a long-term potential. Below 70, that will give me basically about 400 pips, 450 pips. And below that, then it'd be another target there. I have to see what the momentum was. And more recently, in May, I entered a Kiwi US dollar short. Again, coming off the sort of 0.73 area, which is quite a kind of supply area. And then more recently, so last week, I started, because of the demo trading account with Vantage FX, I've done a lot of metal trading, going long essentially gold and silver. XAG is Argentum, so silver. That has been very successful. There has been a lot of chop recently with gold and silver in the last few days. So, but I think the potential is to the upside. So anyway, I've taken a slight gamble with this, gone long with silver. So at the moment, basically, I have currencies, mostly crosses, and then one major. I have equities. I've got a yen pair as well. I've got exposure to metals. And I also have energy with US oil, crude oil. I've been tinkering with this since 2015, to be honest, and also in 2015, I've been tinkering with that. You can see my results in 2015 were very good. In fact, this will load in a second. And I've done quite well with oil, and I'll show you some trades in a second. But essentially, I decided that it sort of rallied back up to about 50 and it crashed back down. And so end of last week, I decided it's time to go long again on oil at 45. So slight negative at the moment, but it also went up recently. So it's sort of fluctuating around that price. If it picks up from that sort of historic bottom, I will be in the trade. So I won't have to chase it. It will just come to me and I'll ride it as far as it goes. So that's a huge sort of supply situation, which I won't go into. But anyway, this 2015 is not loading. What I will do, however, show you my trades here. And these are all my deposits, as you can see. Okay, US oil. I made some nice profits. This was in September. The dates are in American version, so inverse month then day. So 1st of September 2015, I bought oil at 42.96 and sold it back at 42.85, made 89 pips. Let's go further, and this is sort of latter part of 2015. As you can see, I was making some so before I went short long term on the UK FTSE 100, I was making smaller transactions, or the big transactions, but I mean I was making some smaller trades, shorter trades with the FTSE 100 and getting some revenue from that. And then further back, it seems that I had actually taken no trades on on crude oil. Okay, so fine. But basically, yeah, I started thinking that it should be good to get back into oil. One thing I was going to show you was there are lots of things that I use, and I've talked about this in other videos, and for my sort of long-term projections, the commitment of traders from the CFTC, which kind of from the original source looks like this. So if you go to the cftc.gov website, which is the Commodities Futures Trading Commission based in Chicago. This is the futures long format financials, and so if you find that in the website, and basically this is what you get on the Friday for the previous Tuesday. So this is referring to Tuesday last week, but came out on Friday at the end of the day. And you got your currencies and various things. You've got dairy, cattle, and all sorts of stuff. Anyway, we're interested in currencies. So if we look at the Kiwi, for example, look at the pounds, which has been absolutely hammered. And you can see that there are two kind of lots of things that we're interested in. Now the dealer obviously is the the sell side. They sell to the markets, and then other people trade these products. So people who trade the products are different categories. You've got non-reportables, other reportables, and the ones I'm interested in are the leverage funds, say hedge funds, and so speculators, large speculators, and asset manager institutional prop desks in banks essentially. Taking positions. Now, there's a lot of difference sometimes between the leverage funds and the commercial, basically dealers, banks. So you can see that on the pound last week, Tuesday last week, we were 88,000, etc. short contracts, and the leverage funds 68,000. So both quite significant. But let's put it into perspective. So you look at the difference between this. So percentage of open interest. Okay, leverage funds have long the pound 17%, short the pound 29.9%. Okay, so not such a huge gap, more balanced. Whereas the institutional ones are 2.2 long percent and 38.7 short percent. So they're definitely massively short. Okay, and the change is that the change is here. Okay, so from the previous week, we have much more on the short side here, and also the leverage funds much more on the short side, about 6 times more short contracts. So from that point of view, essentially, they both agree that this is 3 times over and this is 6 times over. So they both agree that there's an opportunity there to short the pound. Other things are less clear. So if you go to the there's actually a separate category for euro pounds, believe it or not. These are futures contracts, by the way. So futures work in a different way from spot forex because prices are quoted for a single currency, and also they're based on the US dollar essentially, but they're quoted as a single currency. So you buy a currency or you sell a currency. You don't buy one and sell the other. It's slightly different. So, but let's go to the Kiwi here. And the Kiwi essentially, as you can see, the institutional, the change is they've gone massively short, 173 to 19 contract, and the leverage funds have gone a little bit crazy on the long, 931, and completely opposite in the negative of that, pretty much the opposite side, almost 900 less shorts. Okay. So they are massively long. So here the difference is significant. So the commercial entities are massively short the Kiwi US dollar, as per last week, and the leverage funds are massively long. So 2 different points of view, and the thing that we don't know, because we're the small people, the retail traders, is who is going to move the markets, the commercials or the leverage funds. And clearly we don't have the answer to that. We just have to wait and see. Okay, so that's one. And we looked at the this, which is the Oanda. Oanda is a forex, not just forex, but a broker, particularly a forex broker, and they provide this free graphic version of the data they've just shown you, and you can see that so that's the euro, the Kiwi US dollar is offered in a graphic format. There's the orange line, gives you the orange line gives you the just make it a little bit smaller. You can see the whole thing, and there we go. So the orange line gives you the price, and the price is broken through this 0.70, as I said. I'm going back up to about 0.73, about 0.72 at the moment. Now this shows you the non-commercial positions, which are sort of leverage funds. And it shows here, if you see, the net non-commercial positions are held by large speculators, mainly hedge funds. Okay. And then the prop desks for banks, basically the side of the bank that trades its own money. If you if you look here, you see that the net positioning is positive or long, and then it flipped after the week of the 6th of June, and it's gone short, just flipped completely, and it's been short ever since. Now, it's not massively short, but there are precedents, because if you look back to, just go back a little bit, if you extend this, okay, try to see kind of patterns. So, see when you go short here, this was back in December, January 2015, 2016. It flipped short, it stayed short for a few weeks, and back to long, back to short. And the depth of that short was more significant. So price did respond, and then it started going against, and then the sort of reaction or causation, if you like, that's the difficulty. Who causes what? Does the leading price cause the speculators to withdraw short positions, or does their withdrawal of short position push the price up? That's the difficulty in determining. But the depths of this one, the previous one back in May, June of 2015, you can see how much further price was pushed, and then even as the shorts were taken off, price continued to drop. Okay, so we've not had something of this level, certainly not here in early 2016, and currently we're still in the early stages of that short, and it's looking very indecisive. So I'm not sure how much the speculators will push price back down. So again, this is another point to take into consideration. Another thing that I use is bar chart. In one of my videos talked about hedging, I think, and I talked about this, which is bar chart is a great service because it offers you charts, live charts with volume. So if you look at the S&P 500, this is for the past month. Sorry, 2 months. You can see the volume coming from June to now, and the sell volume. And because this is a centralized market, unlike the spot forex market, you have order flow, so you've got an actual measure of volume, so how much selling goes on, and it's centralized. This is a futures contracts for September, so these ones expire in September, go from July to September. So we have numbers, it's very measurable, and we know exactly how many positions there are. So you can see on the Brexit day, the results, Friday the 24th of June, massive sell. The open was up here, 2.120, and the close was down at 2.020, so 100 pips down. Sorry, I believe that's 1,000 pips. Is it 100 or 1,000? Depends how you measure it, but anyway. So that's the depth of that move, really a big move and big volume. By the Wyckoff law, if you read about volume price analysis, and Anna Cooling as well, her books, a big sell candle, for example, like this, with a big sell body, although this is a pin bar, not a bar, not a candlestick, you can still see that the open and the close are quite far apart. So it's not a big wick, it's actually a full. The high and the low are pretty much similar to the open and the close. So this is a big negative body with a big sell volume. Unless, and then if you look at this, for example, which is okay, this is on the 7th of July. This was Thursday last week. See, there's a strong enough sell volume, but price, open and close, are pretty much the same. Okay, so open was 2.092 and close was 2.092. Yeah, it was a doji. If you looked at this as a candlestick, it's a doji candlestick. which means that there's a flat body, literally like just a dash, and a wick up and a wick down. So big indecision here. And then it rallied back up on the Friday, okay, and open low and open and closed high, but we haven't made much progress so far. So this is where we are with things that I use. I use the Commitment of Traders report, long-term charts, and I use bar charts and volume bars in the futures contracts to kind of compare. And this is silver, for example. Again, big buy. So that's why I decided to go long, because although this big buy was an open and a close, really short distance between the two of them in a massive wick. Okay, this was on the 5th of July. But this is due to continue higher. Historically, there's a huge upside potential as opposed to downside. So that's why I'm there. And then yeah, I do put updates on babypips.com, so you find my updates on my positions, and I update them regularly, so you can see my updates there. So so that's basically where I am. I put them up not every day, but sort of fairly frequently now, just to kind of update people on my account, what happens, and I put things in red where they where things are going down, and green when they're going up. If it's a negative P and L and the negative is getting lighter, I still put it in green to signify that I'm basically shedding drawdown on that position. So these are all my positions. Now, interestingly, you can see that I've recently started considering counter trends. Not so much hedging really, because that's a different thing. I'm hedging in different ways, but this is really short-term, maybe day trades, and I literally just manually open them and close them. I don't put stops ever, but I do close them within a day and take a loss if I have to, no problem. So so the other day I noticed that the pound Kiwi, which I'm heavily long on in spite of that massive drawdown, decided to go short and take profit of 82 pips on a short-term move, and same with euro pound. Didn't go so well, but on balance that's okay, not a bad day for that. Anyway, so that's really something I'm trying to do based on the demo trading that I've been doing recently, getting some good results on day trading. So I decided to use that strategy within my account to sort of prop up my balance, and which again helps the equity eventually as well. So this is where we're at, and investing.com is something I use for live charts, especially at the weekend, because my broker has on Saturdays maintenance. It happens on Saturday, so I can't look at my charts. And Sundays the chart's back on. But I tend to use then investing.com, which has a great set of facilities as well for charts and again live charts, etc. So again, I'd like to thank you for listening to my video, and basically just to come to the final message, which is that long-term trading is not for everybody, and certainly it's been nearly a year. So drawing the sums of my year of trading in this new style, long-term trading, I would say that is a very difficult style, and it's difficult for two reasons. One, you don't get confirmation of your instincts, of your strategies, of your analysis straight away. You have to wait a long time, and that is not for everybody. Some people want to know, am I going along the right lines? It's like, but at the same time, you can't ask that of trading always. It's for a long-term plan. It's like going to university to do a degree for 4 years or 3 years. You can't expect to know in the first month whether that you've chosen the right degree. You have to go through it. And maybe at times you think this is not really relevant. I'm not going to get a job out of this. Or maybe during that 3 years, just like Brexit happened last month, during holding that long-term trade, those long-term trades on pound, I saw the event happening. I was committed to the trade, just like you're committed to a degree. Say you take a degree in finance, and there's a global recession. All the banking jobs go. Banks and financial institutions are in trouble. There are massive redundancies. People are sent. They're fired. off they go, and you think, I'm actually studying to work in that sector. I'm in the third year of a 4-year program. What am I going to do when I finish this? Should I quit now and cut my losses? And the other view is, of course, that you don't cut your losses. You've made a long-term commitment and you stick with it. Okay. And the consequences, unless it's so dire that your life is at risk. My life is not at risk. The funds I'm using for investing or trading are separate from my daily life, so this has no negative impact should I lose everything. So you have to kind of commit to a long-term view, and then once you get through a particular period, you set yourself a period. So I set myself 6 to 12 months. We're coming up to 12 months, okay? So when it comes to next weekend, it will have been a year pretty much to the day of my first trade. And then when it comes to a month after that, it will come to about a year again to my other 2 trades that I came into. So then it's going to be a case of, well, I have to really draw the sums. So between next week and a month from that, it'll be interesting to see if anything happens as well in the next month and a half in the markets that will significantly reposition my investments in a way that makes me think, actually, I wasn't wrong in giving myself a year. If things continue to deteriorate, as currently they seem to be on my trades, then I'm managing them, as you can see, with small short-term counter trades I'm taking, going into diversifying a bit more, going into energy and metals, so I'm really starting to think, if everything converges to basically negate my themes, my thematic trading, and to negate my bias, my assumptions, my analyses, then through time, more and more, then I probably have to take a loss on a big scale, and that would probably have to be just to live another day, or another month, or another year, and it'll probably have to be the pound Kiwi position. At the moment, I'm seeing that as something that has potential to retrace still, and I'll give you a day version of that. We've bounced off that after pretty much a straight week and more of negative 1, 2, 3, 4. 4 is a doji, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Almost 2 trading weeks solid of losses, okay? Going from 2.07 to 1.77, okay? That's 3,000 pips in 2 weeks. That's immense. That is absolutely immense. So we've had a positive day today so far, which is encouraging. But then we've had positive days here, and look what happened. So again, it's too early to say. We've had a period of retracement of this sort of Elliott wave pattern. People call it Elliott wave, or you can call it whatever. It's a downtrend within what was seemingly a head and shoulders reversal pattern. So, but then there was this massive pickup here from 2.4 to 2.20 pretty much. So 1,600 pips, but then we've collapsed since without any chance of picking up. Failed at 2,000, failed at 1.90, 2.0, 1.90, and 1.80 failed as well. But we're creeping back up towards it, so I'm positive from this point on that something will happen. Anyway, we'll just have to wait and see. If things should deteriorate after July, August, then we're back into the situation of, well, do I project another 6 to 12 months, or is it then like if you go and rent a flat, you rent it for 12 months, and in the contract you might say a rolling contract, so then it's a month after that, so it's renewed monthly rather than yearly. So then would I just start projecting a month forward, or just renew it over 6 months? So then say, okay, another 6 months forward, I will assess the situation and just manage it for another 6 months. That is the decision I have to make. I haven't made it yet. I'm making plans, as you can see, just giving another month to assess. But at the moment, the assessment is negative. So it's been a negative year, pretty much, from July to the present day. And this is what long-term trading is, and I've done a lot of reading about this to really try to get a grip on what it's like to be a long-term trader, which is like an investor. The idea is to invest like in sort of buy and hold or a sell and hold. Even then, you have to cut your losses. Don't get me wrong. So this approach probably would attract criticism from a long-term investment point of view because you are holding on to losses, and so I really have to think about that. But a lot of lessons learned, and I hope you found this video of some use. If you intend to trade long term, think about what you're letting yourself into, and think about whether you want to use stop losses. I don't, because that's the style I chose to follow, and so it's a very difficult thing. You're looking at your drawdowns and you're projecting forward. So my drawdown this is over 6,000 pips. So my projection forward from 2.44 for 6,000 pips would be 3.04. So if you put it on a monthly again, 3.04 is up here. Okay, my target is up here, basically. It's in this range, if you like. I would be happy with 1 to 1, okay, and that's basically what it would be, just above 3.0. But if it came close to 3.0 and then sort of retreated, I would take a negative reward to risk, as long as it will definitely pay off my negative swap by quite a bit, so it would definitely be a great reward. And then you have to think about as well, finally, your reward divided into 12 months. So if you gain about 6,000 pips in a year, let's say, okay, that's 500 pips a month, essentially. So if you gained 500 pips a month on one trade, and then try to decide 500 pips a month, it's 5 days in a trading week, times 4, let's say a 4-week month, would be 20 days. So then you go 500 divided by 20. Okay. So it's about 25 pips per day. So if you had that, okay, so let's put it in. So we have it transparently, putting the sums in. So 500 months divided by 20 days, 25 pips per day. There you go. So yeah, 25 pips per day. Now think about, obviously it's not going to be 25 pips per day. It could be 50 pips one day and sorry, yeah, 0 pips the next day. So but think about it for a moment. You have the negative swap, but if you chose the right pair, you could have positive swap, like make euro pound short. It's negative in pips, but it's positive in swap, so I'm getting positive interest. And the other thing is that you're saving yourself a lot of stress, a lot of time. 2 months ago, I became a father, so I decided well before that that I was going to leave my job, my day job, which I did last summer. I left my job, I went self-employed, and it's paid off. And also now I have more time to spend with my my new family, essentially, which is fantastic. So I made a decision based not just on charts and a screen and some kind of fancy dream. I based my decision to trade long term because I made a series of steps that I wanted to have more time for me. Okay, my day job was taking too much time out of things I wanted to do. So if you were to make 25 pips per day constantly or consistently, you'd have to spend some time in front of the charts, probably. There's no doubt about it. Okay, and you probably have some losing trades and try to make up for the losses and have other trades potentially. You have to spend more time day trading, and I decided that I didn't have that time. So for that reason, if I will make 6,000 pips in a year, or even 2 years, in 2 years that would be, and it might just happen in 1 month of the second year, or in the last month of an 18-month period, but then you spread it out and it makes perfect sense. You are basically taking one trade, holding on to it, and when it comes to fruition, it might be thousands of pips, and yes, you've been through a lot of drawdown, but in the end, as long as you come out positive, if you spread it out, you know, as I said, 6,000 pips across 2 years would be 500 divided by 2, 250 pips a month, and that's just on one trade. Now, all the trades I have combined at the moment, the highest drawdown I've had to this day is about 9,450 pips. Okay, so let's take it to 10,000 for argument's sake. If you had a 10,000 pip drawdown, okay. If you did a 1-to-1 risk-reward ratio, that would give you 10,000 pips as a target. Let's say that you achieve that target in between a year and 2 years. Okay, so let's make it into a 2-year target of 10,000 pips. Okay, that's 5,000 pips a year. Okay, now then you have to take into account your swap, so your negative interest, if you have negative interest, your initial commission for the trades, which might be something like a spread of 2 points or whatever. So let's ignore that because it's minimal in this case. Let's take into account the swaps then. So let's say you got £50 or 50 to £100 of swap over 2 years, negative, okay? And let's say that you've earned 6,000 net profit, something like half of that. Let's say half of that, £3,000 all in. So you started maybe with, like myself, at the moment about £800 in my account. I started with about £500. I funded it more recently, but say £500. End up with £3,500. This is all speculative, but you see where I'm going with this. It's the amount of earning you make over time, which counts. And then if you spread it out, it seems like a little every day, and because you don't know when you're going to get the big drive, the big momentum. So the trades here and the trends might come at some point beyond your choosing, and you might have to sit through long drawdowns. So you have to think long term, what the potential rewards are, rather than the day-to-day satisfaction or frustrations. A lot of people would have committed suicide doing what I'm doing at the moment, but I'm thinking through this in a different way. So I hope this has been interesting to you anyway. So thanks very much for listening, and my next update will be when significant changes happen to my trades, and looking for a more positive story, certainly. So it might be next month. I'll give a second part to this update, maybe a shorter one, just to kind of update you on these trades, or maybe when some things come to fruition, like silver or oil, etc., crude oil, and maybe start booking some profits there for those. Okay, thank you very much for listening, and I'll see you in my next FreeFX video. Goodbye.